Hi. So, what I want to do today is I want to quickly tell you 11 steps how to be successful at the stock market. And I'm focusing on value investing. My idol is Warren Buffett. That's why I bought glasses he wears so I see the markets how he's seeing them. I don't use the crystal ball. I am a long term investor. I don't trade. I buy and hold. But now, my 11 steps. I think they can help you. Watch for them out. I don't want to sell you anything. It's just honestly tips because I did a lot of mistakes. I lost a lot of money. And I think a lot of people can avoid it. And here you go. First step, look at the market as like a supermarket. You go there, you want to buy great companies when they are cheap. You go for, the experts call it margin of safety. So when the market is depressed, you go shopping. When there's a discount in the supermarket, you go and grab it. Second step is, the point is like, look at the market as like kind of a manic depressive person, like a psychomanic, because people have all their feelings, they have their fears, their anxieties, they are excited and so on. So what you do is you look down at the market so you understand it better. And then you look for low PE ratios, low price to book valuations, and then you can have cheap, great days to buy. That's a very important thing when you think about the stock market. Go shopping when it's cheap. The next step is, bad stock market years are great, of course. So a poor stock market, I think we have right now, the Dow Jones is at 12,000 and it moved up a lot, but it's kind of stagnation. And look at it, we have PE ratios below 10, we have great dividend yields of 3, 4, 5%. We have, I think, it's right now a great time, and use that time to buy great companies. The fourth step you should watch out is, I would just read a lot of literature, read books, try what you can find about value investing in a store or read online. There's so much stuff out. The more you read about Warren Buffett and all the other value investors, those great investors, the more you read, the more you know, and the more mistakes you can avoid. The fifth step you should do is, diversify is good, but not too much. You should buy a bunch of stocks, great stocks, but don't get distracted. Don't fill up your portfolio with 100, 200, or 300 positions. I've seen some portfolios. It's like it's just too much. Some people they every month they buy a new stock. Focus on a few. If you have one position, try to add more to it. If it's a great one, add more to it in weak times. Don't get distracted. Don't fill up a portfolio with too many positions. And also, the more money you use to buy one stock, the more you will think about it. You don't do stupid mistakes if it's a lot of money for you. It helps if you invest a lot of money, it helps you from doing stupid things. You wouldn't buy a penny stock if it's a lot of your savings are involved. You would do it with maybe $900, but you wouldn't do it if you're investing 20,000. So think it that way. Put strong positions, like Warren Buffett bought Coca-Cola. He put all his money he had at that time in Coca-Cola. Sixth step you should look out is, avoid trading. Trading is something for the masses, but it's not good for the value investor. It's not good for the performance overall. Trading costs money. Trading is very risky, and short term you cannot predict how the markets go. So I would say avoid trading. There are a lot of cases where even bank traders have lost a lot of money. The UBS had a scandal. Nick Leeson is a name you should consider. Bruno Ixkill from JP Morgan, he lost more than 2 billion. So watch out, don't trade. Buy for the long term. You save money on trading costs. You save a lot of money, and you avoid being emotional about trading, because a lot of traders get emotional. Buy and hold. Okay, seventh step, buy only quality companies. Companies that you know and that are that have customers that are happy with those products and services. Think about a client of Starbucks. They're so happy about their coffee, they overpay. Like they pay for a cup of coffee, I don't know, like $2 or $3. It's so much, so they pay a premium. Or think about Abercrombie and Fitch. They pay a huge price. Or Nike, they pay a lot of money for t-shirts with a nice print on them. Like they pay $50, $60 for a cotton t-shirt. So because they are happy, they like the brand, they overpay, and those companies can charge way more than others. Or think about Abercrombie and Fitch. They also charge a lot for blue jeans or whatever. The eighth step you should think about, and you always should look at, is look at it this way. There are companies, they have so much protection because they are so large. Think about McDonald's, they are worldwide. Who can attack them? Think about McDonald's, Walmart, and all the other, Starbucks, large, ExxonMobil. They are everywhere in the world. No one can attack them. They are protected. There is like a wall around them. It's kind of, they look like almost monopolies to me. I mean, how do you want to attack them as a small competitor? They are so strong. They will exist in 20, 30, 40, 50 years. How can you attack Exxon? World market leader, it's the largest company by revenues. How can you attack Walmart? They are all over in emerging markets. They are in the US #1. Like, it's not possible. So look out for those large ones that are worldwide established. You can't get rid of them. They're so strong, they will make it. Whatever happens, they go even through hard times, they go through a recession, they will survive a deep depression, they will survive everything. Ninth step, feelings are of course not good, so avoid corporate events, company events. I wouldn't go to a shareholder meeting. Take a look at the informations you can get online, read the numbers, read a lot, read the quarter results, read the annual reports, read everything. But I would stay away from personal meetings. Warren Buffett is never meeting the managers or talking to them before he buys. Usually he buys based on the information you can get, and that is public. You don't need to get involved. It creates emotional feelings, and analysts usually go every year, several times a year, to a corporate events. They talk to the management. I think there is a little bit a dangerous thing because you get emotional about it, and you know the people and you don't want to hurt them. Most of the analyst reports are buy or hold. No one puts a stock to sell because they are influenced and they want to do business, and I mean, that's the point. The 10th step you should watch out and you should always avoid is like, people get excited about technology stocks, science companies, biotechnology, social media, battery developers, solar cells, and new energy things, and Facebook. And I would say stay away from new trends, from new corporations, stay away from startups. It's too risky. You need a history of earnings. You need 10, 20, 30 years. You want to look back. How did the dividends do the last 20 years? How did the earnings do? You want to have a strong brand, a strong company. The best are the old ones that are 100, 150 years old. That is what you should look for. Avoid those little guys. We see that all the time, that people get excited, they get emotional. They think that's the next rocket, and they buy penny stocks, they buy brand new startups. They're like, it's too risky. I would say focus on old companies, Colgate, Palmolive, ExxonMobil, Heinz, and all these others, General Mills. They exist at very long, and they know what they do. They have great products, they have great brands, they have a huge base of customers, and you know it works. The 11th step you should watch out is, I would say, avoid IPOs. IPOs are always expensive. Companies come public when they get a great price, and don't forget about that. I mean, that's a big thing. You just look at Facebook. Facebook came out at 38 and they lost now 30%. And it's just too risky. IPOs are too risky. They are too expensive, and there's no need to buy. I think Warren Buffett didn't buy an IPO for 40 years or so. And these are my 11 tips. I hope they are helpful for you. Think about it, read a lot, and keep cool. Okay, good luck. Bye.